Should you buy a home in 2024? That is the $412,000 question. And I'm going to help you out by analyzing the analysis of 10 organizations and look at their projected housing inventory, look at the median home price forecast, interest rates, and everything in between. Having said that, all this data is moot unless you are ready mentally and financially to buy a home. Interest rates could drop to 3% tomorrow. The median home price could drop to $206,000 tomorrow. But if you're not ready to buy a home, it doesn't really matter. A couple of the organizations we're going to look at is the Mortgage Bankers Association, Fannie Mae, Freddie Mac, Zillow, and a whole lot more. We're also going to jump back a little bit and give you some perspective and talk about why interest rates are the way they are and talk about housing inventory as well, the supply and demand part of the equation. Now, if this is your first time hearing the sound of my voice, my name is David. I have a background as a mortgage underwriter, a mortgage lender, and also a realtor. So yes, the entire home buying process. I've also purchased multiple homes myself in real life, but most importantly, I've helped hundreds of people just like you buy their first home in real life. Let's go get those keys. Welcome back to House Rich, the first time home buyer show where we provide you actionable steps in layman terms to buy your first home. Let's jump right into it by first talking about some Econ 101, supply and demand. The supply first. Here's a report from Bank of America last October talking about the supply of homes in the U.S. Bank of America housing analysts say that the underbuilding of U.S. homes over the past decade has not only absorbed the 2 to 3 million home glut from the pre-financial crisis overbuilding, but has also created a deficit of over 4 million U.S. homes. So one of the causes of the 2008 housing crash was the huge inventory. They were building homes, so everybody could qualify for a home. Everybody was buying a home. The good times were rolling. And so that was one of the reasons once everything came crashing down, it really came crashing because there were so many more homes on the market than people that wanted to buy them. And so we've still absorbed all that stuff, which is why home prices, of course, have gone up every year since 2012, except for 2019. It was like a 0.5% decline. But now we're 4 million short. This is why in 2023, despite interest rates going up drastically, home prices still increased year over year as well. One analyst pointed out the most direct solution for the housing shortage problem is to build more homes. So yeah, I would say that filed it under duh and also easier said than done because home builders are private organizations that build homes when they want, kind of where they want, and for profit. So it's not like we can pull some lever and be like, okay, like the Federal Reserve, they say they print money. It's not like there's an organization that can, pull the lever. Okay, we're going to knock out 20% more houses in 2024. That 4 million housing inventory deficit will probably be with us for a while and will continue to widen, especially at the bottom of the housing market. Like whatever the bottom of the market is in your local jurisdiction, whether it's 200K, 300K, or maybe, 600K if you're like in a LA or something like that, there is always going to be competitive at the bottom of the market. This is because wages are not increasing at the paces that homes increase. So the person that made, $80,000, like let's say 2 years ago and could afford maybe a $300,000 or $400,000 house. Now that same person can only afford like a $300,000 or maybe a $325,000 house because interest rates have gone up so much and made homes like unaffordable. And so now the person making $50K is now competing with the person making $80K for the exact same home because there's not new inventory being produced at the bottom of the housing market. Speaking of rates, why did they jump so drastically between 2022 and 2023? It was because the Federal Reserve, who raises the benchmark rate or the cost for banks to borrow money, got the mandate from Congress to get inflation down to 2%. Inflation peaked in June of 2022 at 9.1%. This was due to many factors. The Federal Reserve lowering the cost to borrow money right when COVID hit to keep stimulating the economy, corporations raising prices and hiding behind inflation. As of right now, the most recent CPI data that we've seen shows inflation is at 3.1% with the goal to get it down to 2% from Congress. So it's going in the right direction, but like that last percent is very hard to get. If you ever like worked out and you've like cut a bunch of weight, think about that. But that like that, you can never get like those washboard abs, right? Because that last like 3 or 4% of body fat is nearly impossible to knock off. And so that's kind of where we're at with the fight against inflation. We're in like that last like 3 to 5% of body fat to get from like 3 to 2% inflation. So that's going to be a hard, long struggle. And based on the data and projections I've seen, that's going to take maybe like a year to a year and a half to eventually, hopefully, hit that 2% inflation goal, which was mandated from Congress. As a result, that's going to keep interest rates a little bit elevated through the next year and a half, elevated in comparison to where we were at during the COVID time frame, but just a little bit higher than where interest rates normally are, which is like the 4-5% threshold. Overall, we're headed in the right direction. The Federal Reserve kind of telegraphed during their last meeting that they plan to cut rates 3 times in 2024. They project that in 2024, the federal fund rate will fall to about 4.6%. It's at about 5.25 to 5.5% right now. If this prediction holds, it could spark an increased decline in mortgage rates in 2024. Now let's get into the predictions from some of these organizations. I'm going to throw you the red meat out there right away. The 2024 housing market prediction from the Mortgage Bankers Association of America is a 4.1% increase. AEI Housing Center, 4% increase. CoreLogic, 2.9%. Fannie Mae, 2.8%. Freddie Mac 2.6, Goldman Sachs 1.9, the National Association of Realtors 0.7, Redfin flat at 0%, Zillow negative 1%, Realtor.com negative 1.7%, Morgan Stanley negative 3%, and Moody Analytics with the lowest prediction 4.4%. So home prices hopefully will fall somewhere within that spectrum. So there's about an 8% gap in there. What you should take away is absolutely nobody that has looked at the data and is credible and is crunching the numbers is predicting a housing market crash. Like you'll see some bozos online, they'll be like, hey, I found a home in Malibu that the price was cut $500K. But it's like, yeah, that home was actually $2.7 million at one point. And there's a very small pool of people that can afford a $2.7 million house. So yes, home prices will waver wildly at the top of the housing market. But in the middle of the housing market, median home price being $412,000. This is what we're talking about when we're looking at the housing market predictions for 2024. Next, I want to read you the interest rate predictions from Fannie Mae. That's kind of like my favorite organization to get the interest rate predictions from. So they're saying that in Q1 of 2024, rates will be at about 7%. We're obviously below that right now, and this data is about a month old. They had previously predicted 7.6%. So they're like, hey, rates are headed down in the correct direction. 2024 Q2 6.8, Q3 6.6, and Q4 6.5%. Their previous Q4 prediction was 7.1%. They've also predicted out to 2025. They say rates are going to be like in the low 60s throughout 2025. Who knows what's happening in 2025? Because all this data, all these predictions that I'm giving out to you, they're a snapshot in time of right now. If something wildly happens in the economy, up or down, of course these predictions will change, and these organizations put out updates typically quarterly to adjust these predictions with new data, which makes a lot of sense. I'm a realtor in Dallas and would love to help you reach your goals of home ownership. So click the link in the description and just schedule a call no matter where you are on your journey. Not in Dallas? No worries, I can help connect you with a vetted realtor in your local jurisdiction as well. And feel free to share with friends, family, and foes. Everyone gets love. Here are some highlights from those 10 organizations I talked about a little bit ago. Realtor.com, they expect mortgage rates will average about 6.8% next year, and they're expecting, as I mentioned, a 1.7 dip in home prices compared to a 3% increase that we saw in 2023. From Chief Economist Danielle Hill, it will be a bit of a break after what have been pretty relentless home price increase. Some of the pressures and sense of urgency will start to let up. So thinking, hey, people will kind of feel a little bit more relief. I think folks will come back to reality a little bit more perspective on the housing market. Once again, as I say a lot of times, I think that COVID timeframe warped a lot of people's minds about what a normal housing market is. We're not going to see 2-3% rates anytime soon, unless like something drastically happens in the economy or in the world, I would say, such as like a war or something like that. And of course, there's absolutely nothing going on in the world right now that could cause the U.S. to get into a war, is there? Well, on to Goldman Sachs. Goldman Sachs expects inventory to pick up. They say new home sales will climb this year from about 680,000 to 723,000 in 2024. They also say that housing starts will inch higher as well, going from 1.39 million to 1.335 million in 2024. So some new homes hitting the market. Once again, pay attention though to what price range those new homes are, especially if you're in the bottom of the housing market wherever you live. Redfin has said they predict home prices will fall about 1%. They also say that, hey, mortgage rates will average about 6.6% by the end of 2024, leading to a 1% drop in home prices. Home sales will jump 5%, reaching 4.3 million. Redfin also says the high cost will push rent demand higher. So, of course, everyone is saying, hey, should I buy? Should I sell? Should I wait? Once again, that's a decision you need to make on your own. But the idea that somehow rents are going to stay stagnant while home prices increase or level off just doesn't really hold any water. It's another supply and demand thing. The more people that are renting, the higher demand. There's the same supply of rental properties. It looks like rents will go up as they do every single year for real reasons, and sometimes, like, unfortunately, like, just because. From Redfin chief economist Daryl Fairweather, home prices will still be out of reach for many Americans, but any break in affordability crisis is a welcome development nonetheless. Is that welcome to you? Let me know if home prices being out of reach is still cool with you. From Zillow, as I mentioned, they think home prices will stay flat. Buyers shouldn't expect home prices to fall much, but the rate of growth will level off and allow Americans' incomes to catch up. If home prices are going up at the same pace as wages are going up, it doesn't really matter. But home prices are inflating, but the wages aren't inflating at the rate home price, which is why home prices are unaffordable. Mortgage rates will probably hold its current level in the upcoming months as persistent slowdown in inflation makes an uptick in rates unlikely. Going back to what the Federal Reserve says, it seems super unlikely, almost improbable that rates will increase, but time will tell. Taken together, the cost of buying a home looks to be on track to level off next year, with the possibility of costs falling if mortgage rates do as well, says a Zillow researcher. Let's talk about Fannie Mae, my favorite source to get information from. They think mortgage rates will average about 6.7% in 2024, and they think home sales will jump overall across the entire U.S. to about 4.8 million, fueled by a gradual recovery in existing home sales. Fannie Mae said a modest economic downturn will cause a shallow decline in new home sales, though the contraction won't diminish construction volumes in the long run. So those new home builders are still building homes. They're building homes no matter what, because that's literally how they make money. The agency expects prices to continue appreciating, albeit at a slower pace, citing an October survey. It forecasts a 2.4% growth in home prices next year. Now to the National Association of Realtors. Their deputy chief economist, Jessica Lautz, says NAR forecasts that mortgage rates will average 6.3% in 2024. So hopefully NAR is a little bit closer to where rates are than everybody else. That'll be some welcome relief when it comes to interest rates for everybody. Last but not least, I said Fannie Mae is my favorite organization. Probably my favorite analyst himself is this guy called Logan with Housing Wire. So I want to read you first what the 10-year yield is. Treasury bond yields are rates tracked by investors for many reasons. The yields are paid by the U.S. government as interest for borrowing money via selling bonds. The 10-year Treasury yield is closely watched as an indicator of broader confidence in the economy. Because Treasury bonds, along with bills and notes, are fully backed by the U.S. government, they are viewed as one of the safest investments. So a lot of times, investors track how the economy is doing based on what's called the 10-year yield. Now let's see what Logan has to say about the 10-year yield and how it impacts home prices and rates in 2024. The spread between the 10-year yield and mortgage rates can get better in 2024. This means that mortgage rates could be 0.625% to 1% lower than next year. For example, rates would be under 6% today if the spreads were normal. Instead, they closed 2023 at 6.67%. If the spread gets anywhere back to normal and the 10-year yield gets to the lower end of the range in 2024, we can expect sub 5% rates in 2024. That is the most aggressive prediction. And if I didn't respect Logan so highly and his analysis and just sticking to the data, I wouldn't even have said this. I wouldn't even have given you guys this prediction because I don't like to throw out just like clickbait or get you too excited from something I don't realistically think it's going to happen. And also, like, he just follows the data. If something happens in a month or two and it looks like interest rates will maybe be at like 6.5% for the rest of the year, he'll come out and be like, okay, this is what the data says now. He doesn't have any horse in the race. His only allegiance is to the data. He also says if everything stays consistent, 2024 home price growth levels will repeat what happened in 2023 with single digit national home price gains. Now, what could possibly cause home prices to actually increase maybe higher than the single digit projections? Well, he says that if he's wrong and mortgage rates go lower for longer and we don't get more new listings in 2024, then home prices can grow faster in 2024 because we have the same issues as before. Too many people chasing too few homes. So we end this note on a supply and demand analysis. So my analysis, somebody that just reads other people's analysis, is from what I've seen as far as the Federal Reserve forecasting, telegraphing that they're going to cut the cost to borrow money. I think rates will probably be in the lower half of that 6% threshold, like 6.25 by Q4. And also throwing in the fact that there's an election year. You know, the current regime always wants the economy to be doing good during that time frame as well. So there's a little bit of incentive to kind of tweak indicators. And the U.S. government does not control the Federal Reserve, but you know they can kind of nudge them a little bit to help things out there. And once again, inventory is historically low. There's really no incentive for home builders to build homes in the affordable portion of the market. The only reason they do build them is if they get incentives from the government to build affordable homes. And even with those incentives, the margins aren't as great for them when they just build homes whenever they want. So unfortunately, that is the root cause of there being a lack of housing inventory at the bottom of the market. And I'm not sure there's any way, unfortunately, to correct that. But that's just capitalism. Like, people are going to do stuff that creates money for them. Does it suck? Yeah, it does suck, but that just kind of unfortunately is what it is. If you got a solution for that, please let me know. I am very interested. But as always, buy land. Rumor has it they're not making any more of it.